Hi everybody, welcome back to the channel, and today I thought we would take a look at some examples of how you could realistically make $1,000 per month in dividends. And these examples are going to be just hypotheticals, so keeping that in mind, we're going to be looking at a few different stocks in this video, and we're also going to be looking at an ETF. Now, depending on your specific strategy, there are a number of ways to get to $1,000 per month in dividends. And when it comes to this, keep in mind that it's kind of like a snowball, because once you get to $1,000 a month in dividends, it's going to be easier to get to $2,000 a month than $3,000 a month, and so on. And so our goal is really to hit these initial goals early on if we can. For example, my goal is to retire by 40. I'm going on 29. I will be 29 this year. But in order to do that, I have to have a plan of action in terms of how I'm actually going to get these dividends that I need to support my lifestyle. And so by going over this, hopefully this will help you kind of come up with a game plan in terms of what you're seeking for your own portfolio and how realistically you might be able to make $1,000 in dividends. So the first stock, as you'll see on the screen, is Realty Income Corporation, and this is a real estate investment trust. And one thing about this company is that they have been very consistent with raising dividends. And I'm using this as an example for that reason, because I want to kind of illustrate something. And if we go back even to, let's say, the last 10 years, so going back to 2014, hard to believe it's been 10 years already since I was back in high school, but the point is, if we're looking at this from, let's say, 18 cents a share, okay, back in 2014, June, they were paying 18 cents. Now, they've been raising their dividend every single year since then, because they're what's known as a dividend aristocrat, which basically means they increase their dividends every year. So if we take this dividend, in fact, we'll plug this into a percentage increase calculator. So this is a simple way you can just plug in these numbers without having to do it by hand. And what you can do is plug in this number here, and you can see what your actual dividend growth would be since 2014, exactly 10 years ago. And just by putting in this number, 0.1827917, a lot of digits, but as you'll see, since then they've increased their dividend, and now they're paying 0.263. So you can kind of see what the total amount of increase was just on those initial dividends. So it's a 43.87% increase. And so that's one thing to really consider. Now, obviously, we've had inflation over the last 10 years. I think everybody can agree that inflation has been relatively high. So then you have to factor in, like, okay, is this even keeping up with inflation? Because when you have inflation into the mix, it gets tricky just due to the fact that, yes, this is your gross return, but what's the actual net return after the cost of living, right? But keep in mind, we're also probably assuming that you're going to be reinvesting these dividends in the meantime. So that's another way to compound your wealth, is to simply take the dividends and reinvest them. So if you can delay your gratification, then you can compound this snowball a lot faster. But with that being said, we have a 43% increase over the last 10 years. Now let's take a look at another company, Coca-Cola. So this is one that Warren Buffett owns, and he's owned this stock for quite some time, and I think even since the late 80s or early 90s. And so he's made a lot of money just on the dividends going up. If you look back at their dividends, going back to the early 2000s even. But the point is, it's all about compounding. It's all about snowballing these dividends. And so let's go back 10 years once again. You'll see that we have June 2014, they're paying 0.305, and we can kind of look at that dividend, 0.305 times the current dividend, which is for Coke going to be 0.485. So plug that new number in, and voila, we have 59%. So better than Realty Income. But of course, that's probably why it's important to diversify. And when it comes to these types of stocks, remember, this is just based upon the dividend increase alone. So this is not assuming that you're reinvesting dividends. This is also not assuming that you're putting more money into it every month, because when you do those two things, it really accelerates that snowball, kind of like when you're paying off debt, except this is something good that you want, right? We don't want a bunch of high interest credit card debt, but it kind of works in the same fashion, except in reverse. There's this snowball effect, whereas the more interest you have on your credit cards, the more that's going to compound, and unfortunately it's going to eat at you alive in terms of your monthly expenses. But the same thing with this, if we can find a way to compound and snowball this dividend, then we can perhaps retire off this someday and earn enough from these dividends to pay our bills and to have that cash flow in order to basically, retire and live off these dividends. And so that's the entire goal. Now, when you look at an initial dividend yield, assuming you were just going to put a lump sum into this, like for Coca-Cola, for example, 3.03%. So how much would you actually need invested just to do that? And if we look at this, let's just take $100,000 times 0.0303, and you're looking at $3,000 a year in dividends divided by 12 is $252 per month. So essentially we can multiply this times 4, get $400,000 invested. And remember, this is not assuming any future dividend growth. That's what's so powerful about this. If you're investing in the right companies, then you're going to get that future dividend growth most likely, or we hope that you would get that future dividend growth. And so if we take it now, $400,000 at a 3% dividend yield is going to be roughly, that number you're shooting for. So $400,000 times 0.0303 is going to be $1,000 in dividends. And with that being said, I mean, that's per month, but like I said, that's not taking into account any additional growth in those dividends, or if you're actually putting more money into this at the same time. So $1,000 in dividends on $400,000 might seem like a lot, but when you can compound these other factors and the long-term snowball effect, that's when it gets interesting. So if we look at Realty income, excuse me, we have a higher dividend yield initially, so you're going to not need as much initially invested. But remember, Realty income had a lower growth rate than Coca-Cola did. So taking a look at this, if we have, let's say, we'll try another $250,000 times the current yield of 5.87%, 0.0587, and we have about $14,000 divided by 12 on a monthly basis, and we have $1,222 per month. So we've actually kind of overshot this. We can say do $225,000 times 0.0587, $13,000 a year divided by 12 is $1,100 a month. So still, I mean, maybe we're looking at more like $200,000 times 0.0587. That seems more realistic. So basically cut in half from Coca-Cola's number, and we come up to roughly $1,000 per month. So that's two ways you can look at it. Now, that's on the individual stock level. So if you're investing in individual stocks, you're investing in companies that pay these dividends and have been doing so for a long time, and hopefully raising those dividends, as we've seen in the case of Coca-Cola, as we've seen in the case of Realty income. Now, keeping that in mind, of course, future performance is never guaranteed, but if we have a track record of dividends to work with, then it kind of makes those cash flow predictions easier. So with that being said, we can jump over to an ETF like JEPQ. Okay, so this is going to be different. Now, this ETF is known as the JP Morgan NASDAQ Equity Premium Income ETF. It's actually one of my favorite covered call ETFs out there. And as you can see, the share price has gone up since 2022 at $40 a share. Now we're trading at 55. But the real kicker with an ETF like this is that huge 9.8% dividend yield. And you could look at this and say to yourself, well, if I only invest $100,000, okay, so let's take, $100,000 investment times 0.0987, and what do you get? You get $9,870 per year divided by 12, and you have $822 per month. So not quite, but let's take $125,000 initial investment times 0.0987, and we get $12,337.50. Then we can take that divided by 12, and now we're at $1,000 per month. So essentially, all you would need is to invest in JEPQ is $125,000. So you would need the least just based upon that initial dividend yield, which makes sense because it's yielding 9.8%. But then the question becomes, where do these dividends go long term? And also, where does this ETF go long term? Does it keep going up? Does it go down? Where does your principal lie? Coca-Cola, I would say, has been kind of flat, I think, over the last several years in terms of its share price. Has not done a huge amount. We could look at the price of Coke. It's trading at $63 a share. And, over the last 5 years, it's up 25%. So not a huge amount in the share price growth, and obviously, Coca-Cola is a very well-established company. This is not like Nvidia, which is going to be flying off the charts or anything like that, especially when you have that nice stable dividend. So it's going to go up and down less than one of those major growth companies, obviously. And then we have JetQ. So this one's up 12.26% over the last 5 years, but you get a much higher initial dividend yield. And this is why so many retirees are attracted to these ETFs, because of the fact that they yield basically very sizable dividend yields, is what I'm trying to say. So this ETF came out in 22. You'll see they had some initial dividends fluctuating around 30 to 35 cents, 40 cents a share. They've had some dividends as high as 50 cents per share. But you'll see that there's not going to be as much consistency versus a company like Coca-Cola, right? So even though you get that lower initial dividend yield, you have predictable cash flows, because you know that most likely, unless something drastic happens in their business where they have to cut their dividend, but most likely, they've been paying dividends for decades and raising those dividends. 0.485 is going to be that number, if not higher, next quarter if they decide to raise the dividend. But same with Realty income, right? So you have a predictable cash flow where the dividends continually go up over time, and 0.263 is that most recent dividend. So worst case, you're probably anticipating 0.263 is that dividend. So with that being said, we can come over to JetQ, and now it's kind of all over the place. So you don't have as much predictability. It's kind of like a surprise dividend every month. And that's the other thing about this ETF is you get paid every single month, which is nice. But if you're a retiree, you might be looking at this and say, well, I have a 9.8% dividend yield, and I'm getting paid on a monthly basis. But the one trade-off with an ETF like this, I would say, like I said, first of all, the cash flows are not going to be as predictable, but also, where's the future growth, right? Do these dividends actually go up over time? How much do they go up by? And then where does this share price go? Because one of the major drawbacks of these types of ETFs is that over time, you can see this, what's called net asset value decay, where the share price actually starts to go down due to basically these high dividends they're paying, but then there's not as much focus by the fund managers in terms of the share price, right? So there's always that risk as well. But assuming you're well diversified, and take a look at one other stock here, just as an example, I talked about this one in my last couple videos, Rio Tinto. Now, this is a company that's not very volatile either. You'll see it's nice and flat. And another way you can get cash flow on your portfolio, besides just dividends, which I talk about on this channel, is through what's called cash secured puts and also covered calls and things like that. So this actually, in my opinion, would be a pretty good stock to do what's called the wheel strategy against, where you get those consistent cash flows. And the reason for that is due to the fact that the stock is pretty much sideways trading at this point. But if we look at the dividend for this company in particular, this is where it gets interesting as well, because you have a 6.55% dividend yield. And if we're trying to make $1,000 a month, let's take a closer look here. So NASDAQ says 7.77%, depending on the exact source. But the calculation for dividend yield, you just take it, and you can figure that out yourself if you want, based upon the current price. But with that being said, you'll see that these most recent dividends are kind of all over the place, just like the JetQ ETF. So there's a lot more variability. But when you do get those large dividends, $4 a share, then you're really talking substantial cash flow. And what I will say is that these dividends for Rio Tinto have been pretty consistent. Like that yield you'll see, 7.77% in terms of that higher dividend yield going from 6 to 9%. You're really going to be looking at that in terms of this stock, I would say, just based upon the previous history. Once again, we don't know for sure that things are going to pan out that way in the future. But if we assume that Rio Tinto is going to keep on, paying these sizable dividend yields, then we can kind of take a look at this as well and say, okay, they pay a 7.77% dividend yield, and then we can take, let's say, 150,000 or 175,000, I'll say, and we'll multiply that times 0.0777 according to NASDAQ.com, which is $13,000 a year. And you'll see here that now we're getting over $1,000 per month once again. So, looking back over the last 10 years for Rio, they were paying $1 back then, and now they're paying, a lot of these dividends are over $2 a share. So keeping that in mind, you just have to look at all these factors and ask yourself, like, what's best for your portfolio. But what I will say is there's really two ways you can look at this. You can look at the initial dividend yield and say, how much would I have to invest? But then you can also look at the potential growth of those dividends, and are those dividends going to be sustainable? And I think that's the most important point for any investor who's looking at this long term. I know it's tempting just to look at the dividend yield and say, wow, that's a nice dividend yield, 7.77%, 9.8%. Let's run the numbers and see how much it would take to make $1,000 per month. But on a deeper level, there's the fact that these dividends, if they're being cut, then that's obviously not good, right? You're losing money in that case and you're getting less income. We want to make more income, so we also have to look at the potential future growth of these dividends. And then, of course, there's inflation and other factors you have to take a look at. So there's a lot, right, when it comes to really putting a portfolio together where we could potentially make $1,000 per month or more from dividends. But with that being said, it can be done, and there's plenty of people who do this, right? There's plenty of people who put money into the JEPQ ETF. When I worked at Schwab, I was on the phone with a guy, and he had, I think, $400,000 invested into this ETF, and I think JEPI was the other one, and he was probably making about $3,000 to $4,000 a month just in dividends, and he had less than $500,000 total principal invested. But and he was in retirement, so he was enjoying the fruits of his labor. He was using ETFs like this to generate monthly checks, basically, and it was working out for him. But will it work for everybody, right? There's a lot of factors to consider. So with that being said, let me know what you think in the comments down below. Thanks so much for tuning into this video, guys. Hope you learned something, and I'll see you in the next one. Take care.